welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll be discussing both the importance of cash as well as its challenges when using it as a long-term investment. This is timely and relevant right now because some investors have flocked into cash in recent years as a response to stock market volatility and due to higher interest rates. It's important to emphasize that cash plays many important financial planning and investment roles. When it comes to financial plans, it's important to have enough cash on hand for expenses and important life events such as buying a house. However, the problem is when investors have too much cash on hand when compared to what is necessary. In these cases, they might be giving up growth opportunities in other parts of their portfolio. In the next few minutes, we'll discuss the many considerations investors should be aware of as they think about the role of cash in their portfolios, especially as the market and economic landscape shifts in the coming months. First, this chart shows that significant amounts of money have flowed into money market funds in recent years. Money market funds hold cash-like short-term instruments. Their asset levels tend to rise in times of market uncertainty and when interest rates are higher. Both of those factors are at play today. You could see that assets increased during the pandemic as investors were seeking safety. However, interest rates are higher since 2022, and that has also led investors into money market funds. Investors looking to take advantage of higher cash rates have invested in these funds to generate more portfolio income. At the moment, total assets across money market funds now exceed $6 trillion. This is more than double the average level during the decade following the global financial crisis. Second, while cash rates may be higher, they do not necessarily offset the higher levels of inflation. After all, interest rates are higher exactly because inflation has been higher over the past few years. This chart shows the level of income of a hypothetical investor might receive after investing in the average certificate of deposit. While these rates have risen, they are still negative after adjusting for inflation. In other words, inflation erodes the purchasing power of cash, which is only partially offset by these interest rates. Thus, one challenge of holding too much cash is that inflation can still eat into this income. Another problem is that yields are not locked in. By definition, cash rates are short-term, so investors need to reinvest their cash periodically and hope they can still find attractive rates. This is different from investing in long-term bonds or the stock market. Investment-grade corporate bonds, for instance, have yields averaging around 5.5% right now, far above the average from the past few years. Finally, this chart shows that while inflation has been a problem over the last century, stocks and bonds historically have outpaced it. For example, what cost $1 back in 1926 would cost $17 today due to inflation. However, $1 invested in the S&P 500 back then would be worth a whopping $13,000 today. While the past is no guarantee of the future, this historical example emphasizes the importance of investing properly. While cash can play many important roles and it's always needed for important expenses, it does not replace a proper allocation of stocks and bonds. We hope you found these insights valuable. If you'd like to discuss any of these topics in more detail, please don't hesitate to reach out. We look forward to speaking with you.